Smart money added exposure again this week. So my primary gold bias remains heavily bullish, but the real opportunity? It requires extreme patience. We're waiting for a very specific liquidity sweep first. Let me show you what institutions are already positioning for. This explainer reveals their exact footprints in the market. We'll decode the data to pinpoint the entry. We'll outline the precise weekly execution plan. You absolutely need this data before the market opens.
Based on current liquidity conditions, institutions have a clear objective. They're positioning to sweep liquidity resting above recent highs, specifically that 4,100 to 4,150 level. Why this specific zone? Well, it's a massive pool of buy stops. Most traders are going to obsess over pure price action. But smart money, they solely focus on liquidity engineering. They literally need these retail stops to exit their heavy long positions. This objective dictates every institutional move this week. We're simply going to follow their engineered path.
So, let's dive right into the smart money capital flows.
Retail traders see a sudden drop in long contracts. They immediately assume the bull run is completely over. They start aggressively shorting the market. But here's what most traders are missing entirely. They totally misinterpret the actual intent behind these institutional numbers. They're reading the data completely backward. This creates the absolute perfect liquidity trap. The real institutional agenda is completely different. Let me explain what the data actually proves.
Managed money remains heavily net long across the board. They currently hold over 116,000 contracts. That recent reduction of 6,000 longs, it's merely tactical profit-taking. It is definitely not a structural regime shift. Smart money is holding their core long exposure tightly. They anticipate significantly higher pricing in the near term. They're just trimming the fat before the next expansion. This perfectly confirms our bullish institutional bias. The heavy lifting is already done. Now let's look at the macro confirmation signals. Asset managers added over 79,000 long contracts in 10-year treasuries, and they added nearly 10,000 in 5-year notes simultaneously. This aggressive institutional buying points directly to lower yields. Falling yields remove a major structural headwind for gold. Institutions are quietly paving the way for higher precious metal prices. They're aligning the entire macro environment first. This is exactly how smart money prepares for a major expansion. The bond market reveals their true narrative.
The US dollar index dropped 1.49% just this past week. Institutions are actively unwinding long USD exposure in spot markets. Why is this so important? A depreciating dollar provides a highly bullish catalyst for gold. Capital is rotating out of fiat and into safe haven assets. This orchestrated dollar weakness is absolutely not a coincidence. The macro winds are blowing firmly behind our gold bias. Everything is aligning perfectly for a massive expansion higher.
Let's map this all out with the ICT order flow mapping. This is the macro weekly structure we are navigating right now. We're currently operating inside a strong secular bull market. Price is effectively consolidating near that 40-48 benchmark level. This is a very healthy consolidation after a violent vertical rally. Institutions are simply reloading their massive positions. They're building a strong base for the next major leg higher. There is absolutely no bearish structural break here. The long-term drawn liquidity remains firmly above us.
The daily time frame currently shows a short-term change of character. However, this perfectly indicates high probability range-bound accumulation. We have clear institutional demand below and clear supply above. The market is coiling tightly like a compressed spring. It's actively winding up for the next volatile leg higher. This consolidation phase is deliberately designed to frustrate impatient retail traders. It forces them into early, low-probability entries. We will wait patiently for the spring to release.
On the 4-hour time frame, our high-probability intermediate setup finally emerges. Notice the specific fair value gaps left above current pricing. But more importantly, identify the key bullish order block resting below. This is located perfectly at deep discount levels. This is our highly anticipated institutional reaction area. This is the exact zone where we hunt for entries. Smart money will look to accumulate orders right here. We simply wait for price to deliver into this discount.
Precise execution in this environment requires extreme, unwavering patience. You absolutely cannot buy blindly into structural support. We must witness a lower timeframe liquidity sweep first, then we demand a structural shift on the 1-hour chart. This exact sequence fundamentally confirms strong institutional sponsorship. It proves smart money is actively defending the discount level. Without this confirmation, you're honestly just gambling. Discipline is what separates professionals from retail liquidity. Which brings us right into the retail trap.
This is exactly where most retail traders will ultimately get trapped. They'll aggressively attempt to short into strong USD weakness, or they'll blindly gamble on Friday's volatile non-farm payrolls data. Institutions will use this exact data volatility to collect retail liquidity. They'll engineer aggressive stop runs during the news release. Do not become their liquidity during these high-impact events. This is a calculated trap designed to wipe out early positions. We must sidestep this volatility entirely.
So what is our specific weekly execution plan?
This is our absolute primary activation condition for the week. First, price must explicitly sweep lower liquidity directly into 4-hour demand. Second, we must see a 1-hour market structure shift print clearly. This shift must be energetic and decisive. Only when both specific conditions are fully met do we execute. We execute the long entry with absolute confidence. If this specific sequence doesn't unfold, we do nothing. We stick strictly to this institutional process.
Once triggered, these are our highly precise institutional profit targets. Target 1 is the immediate local range high liquidity pool. Target 2 scales out volume at the daily supply zone. Target 3 is the final retest of all-time highs above 4,100. We scale out systematically as price reaches each critical objective. This secures profit while leaving runners for the macro expansion. We always pay ourselves at key external liquidity draws. This is professional trade management in action.
Strict risk management is entirely non-negotiable in this professional business. A daily close below major structural support invalidates this entire setup. That is the exact single condition that proves this bullish bias wrong. If that happens, the institutional narrative has fundamentally changed. We accept the calculated loss immediately and step aside. We don't hope, and we definitely don't hold losing positions. We protect our capital for the next high-probability institutional setup.
If you value institutional gold analysis using smart money concepts, subscribe to ICT Market Theory. I really want to hear your perspective on this setup. Leave a comment below with your specific weekly gold bias. But before you place a single trade, remember this explainer. When the engineered volatility hits the markets later this week, ask yourself, are you trading confidently alongside the smart money? Or are you simply providing the liquidity they need to exit? Stay disciplined and protect your capital.